This is Chapter 10, Performance Evaluation. I guess we're just going to sit here. Let's see. Okay, this chapter has several main areas, all right? So the first thing is to understand why we have decentralization, okay, why that's even important and exactly what it means, and then what we mean by a responsibility center. And then if we've got these different centers, we're going to develop performance reports for them. And some of the tools that we use to do this is to look at return on investment, sales margin, and capital turnover. Okay, and then we'll look at the next thing now, a whole another area. It's related to this, but it's a separate issue, are transfer pricing. And that's when one division of a company sells something to another division of the same company. Okay, how do you set the prices for that, and what are some of the issues? And then we'll look at another separate issue is flexible budget performance reports. Okay, that's another whole thing to, like, another piece of decentralization. Okay, how we hold people responsible for what the goals are. And then the last piece of it is the balanced scorecard and key performance indicators. Okay, so these are several big topics inside of a big area. Oops. Oh, for God's sake. Here we go. Okay, so the first thing is understanding decentralization and different types of responsibility centers. Now, when we say decentralize, we mean to split an organization up into different segments. Like Coke has Europe, Europe, East Asia, and and all of Africa in one segment. Okay, so that's decentralization. So that group makes decisions for itself, and management delegates decision-making responsibilities based on how it's split up. And it could be geographically, like Coke is. It could be according to a product line. All right, so like cosmetics are, I think there are only three cosmetic companies in the world, but they're broken apart into all these different product lines like L'Oreal and Maybelline. I actually think those are the same company, but they're different divisions of the same company. Okay, a distribution channel, customer base, or business function. Okay, so that's what we mean by decentralization, and what we're really trying to do is to operate to maximize profit in what the potential for the company is. Advantages: it frees top management's time because you're really driving decision making down to a lower level. Encourages the use of expert knowledge, whoever's closest to the product and the division or the geography. Improves customer relations, provides training for people, improves motivation and retention. There are a lot of reasons to do it, but there are two disadvantages listed here, and one is really important, that you might duplicate costs. Okay, you might have some administrative costs that maybe would be better to be centralized. But the big thing is that you've got a problem making sure that the goals of that division are consistent with your own. Okay, that's the real problem. So potential problems and achieving goal congruence. That's the real issue. So what we do is we divide these organizations up, and then we come up with, we need to have some feedback on how they're doing. And that's what performance evaluation in an organization is. But to be effective, the system should communicate expectations clearly, provide benchmarks that promote goal congruence, and then motivate the segment managers. Okay, you've got to make sure that all the incentives are lined up the right way so you don't alienate your management. And responsibility center, then, is a part of an organization whose manager is accountable for planning and controlling, that's management, certain activities. That's a responsibility center. So here they've got an example of lower level managers are often responsible for budgeting and controlling costs of a single value chain. Okay. When you might, a geographic one would be, say, much bigger than that. Of course, it depends on the business. And responsibility accounting is a way to evaluate the performance of each responsibility center and its manager. Okay, that's responsibility accounting. So in the first place, you've got a responsibility center, and how do we evaluate it? We use responsibility accounting. And this is a good slide. Don't skip over it because it's in pictures, but this distinguishing responsibility centers between what is a cost center versus a revenue center versus a profit center versus an investment center is key. You need to know these things, all right? These are in multiple choice questions. So a cost center, okay, managers are just responsible for controlling cost. Okay, and this looks like Pepsi here. This manager is just responsible, is not responsible to sell the Pepsi, just to keep the cost down of producing it. Okay, so now let's look at the next layer up. That would be a revenue center. Now a revenue center, like in a revenue center, here their example is Frito-Lay. That's a good example. Like the Midwest sales region, managers are responsible for generating just sales revenue. So a revenue center just looks at sales. And I mean, you think about Pepsi, whoever's selling Pepsi, that would also be a revenue center. But the cost center would be the production of it. Just like for Frito-Lay, the cost center would be the production of the Frito-Lay products. Okay? Now a profit center is a little bit different. A profit center manager has responsibility over both revenue and cost. Okay, so when you think of profit center, you want to think about the income statement. So it's going to be the revenue piece plus the expense piece. Okay, they're responsible for the whole thing. And then finally is an investment center. And an investment center is almost like a whole separate company. Okay, like the Frito-Lay division. The responsible for income, which means costs, revenue, okay, cost, revenue, and also the investment in the center. Okay, so cost, revenue, profit center, and then investment center. So the investment center includes all of these. Okay, alrighty. So let's see what we're going to do with that. Here's a good example. Here's an organization chart. I'm going to see if I can make it. It's a nice example of it. The CEO is here on the top. Now the investment centers, say for somebody's corn chips, oh, this is Frito-Lay North America. I'm trying to read the bag. Frito-Lay in North America. Okay, Vice President of North American Beverages would be another one. Vice President of Quaker Foods North America. And then say a vice president of a geographic area, okay, for Asia, Middle East, and North America. Okay, these are all investment centers. So these vice presidents would be responsible for invested capital plus cost and revenue. Okay, then underneath this would be your profit centers. So here we've got the manager of Pepsi. That's a profit center. So it's cost and revenue, but no assets. Okay, here's Gatorade, cost and revenue. Tropicana, Mountain Dew, Aquafina, these managers of these profit centers are responsible for costs and revenue. Okay, and then we'll pick this up at looking at performance reports.